Recording in progress.
Good morning, honorable members. Alan and Tebu, we still have 4 members of the committee.
Good morning, Chair. It's Alan. Currently, as it stands, there's 7 members. That's yourself, Dorothy Mabiletsa, Floyd Shivambu, Zanella Nkomo, Voter Wessels, John George, and Ms. That's 7. Good to start, Chair.
Okay. As the minister and the deputy minister connected here, I spoke to the minister last night. He made a commitment that he will come and attend the first part where he will do the introductory remarks, and then he will leave at some stage. Cindy, is the minister attending?
Morning, everybody. Morning, chairpersons and honorable members. I haven't heard from him as yet, and I'm just checking on the chat that he hasn't connected as yet, but I will just double check with him as well. I don't know if Momo is here as well. I see the Younger and Chris is on. I don't see Momo, but let me just double check.
Struggling with the link, Cindy. I've just sent it to him again.
Okay. Let me just quickly check for you, chairperson, and then I will definitely come back to you.
Okay.
Honorable Chairperson.
Yes, Comrade Cindy.
I but I've just tried to get hold of his office. They're just trying to get him to log on to be able to, and I think they're also struggling a bit with the link. But he said the office says you must maybe commence and then he will join, and then I must just alert you when he's in.
No, okay. And the Deputy
Thanks.
Minister?
The Deputy Minister, unfortunately, I think the Deputy Minister's got another commitment, Honorable Chairperson, and he's not, he will not be able to join the meeting this morning.
Oh,
I think
okay,
he's
okay.
en route trying to get to Cape Town.
Oh, okay.
Okay, thanks, Honorable Chair.
Thanks. Let me get the video right. Oh. Okay, check 1, 2. I'm told we're supposed to switch on our videos, so I'm trying to get it right here. Okay. The meeting is officially open. Let me take this opportunity to welcome back colleagues, members of the Standing Committee Finance from recess. Welcome back, colleagues. Let me welcome officials from National Treasury. You are welcome. Welcome the SARS Commissioner and officials from SARS. And then welcome in advance the Minister who's going to join us. We are back to that season of TLAB, TALAB, and draft related and monetary amendments, amounts and amendment of revenue laws bills. There are colleagues that we only see them once in a year, younger and a team. At least Comrade Momo is more visible when attending other business of National Treasury. So you are all welcome. Apologies, the Minister will join us late. The Deputy Minister is on his way to Cape Town for another departmental business. Are there other apologies?
Chair, from Standing Committee on Finance, no apologies.
Okay, no other apology. Then let's move right away to item 2. Briefing by National Treasury and SARS on the draft taxation laws amendment bill, that is TLAB, Momo, I'm getting used. Then there is draft tax administration amendment bill. This one is TALAB. And the draft rated and monetary amounts and amendment of revenue laws bills. Over to you. I'm not sure who start. Is it you, Comrade Momo, or is it Young?
Yes, Chair, I'll start. And sorry, yeah, this is an annual ritual, and morning to all the honorable members and everybody else. We're always happy to be here. As Chair, as I said, this is an annual ritual. We've got to pass the tax laws every year. And just to remind ourselves that they arise from the tax announcements that the Minister of Finance makes in the budget in February. Chair, we've got quite a big team. I won't go through all, but like you said, there's Yanga and Chris and Franz, but I know that on both sides, we have other colleagues who have joined us and who may come in. So, Chair, just to provide further context, so we obviously take on the proposals that were announced in the budget, and we try and say to everyone that the only tax proposals there will be for the year normally are what's announced by the Minister on Budget Day. However, we've had to change the line slightly, that just given COVID, last year we had to make special announcements on exemptions and deferrals. And so too, we had to do this year, last month. There's a few deferrals and exemptions which go beyond what was announced in the budget, and which we're trying to merge into the tax bills that you see today. I don't know where's the slides. Can we put up the slides? Yanga or Chris, are you putting it up? So, Chair, and can I just say that, so these were the emergency measures that we put up so we'll merge the two processes, because fortunately it was done early enough, and we've learned from the experience last year, and we now have the underlying legislation from last year that we can piggyback on. I think we're fine for now. If the expanded measures related to the employment tax incentive, where we expanded on the age eligibility criteria. Secondly, there's a deferral of the PAYE and tax, and there's a deferral also of the excise duties on alcohol beverages. So we'll deal with all of those in today. So, Chair, and just to remind ourselves, next slide, please. You know, there is the TLAP, which carries the main tax proposals in detail, and just outlines all the 7 areas that are covered here. There is a draft TALA bill, which is carries the administrative provisions, and it does so because the Constitution requires us to split tax legislation into money bills and non-money bills, because if there's substantive administrative issues, they have to be in a separate Section 75 bill and not in a money bill. Next slide. Sorry, Chair, I should just add that the rates bill is just normally a bill that we put forward because it deals merely with the rate adjustments or threshold adjustments, and it's a much easier form. And we actually published the first draft on Budget Day, and then we get comments. And this year, because of the emergency measures, we had to take comments again for it. So we'll deal with those as well. So that's why you have 3 tax bills every year now. Chair, if you look at the emergency tax measures, so let me just deal with that first. So they were announced by the President on the 25th July, and the Minister of Finance then made a more detailed announcement on the 28th July. And obviously they're in response to the COVID pandemic and the recent unrest that we saw in the country in early July, especially in KZN and in Gauteng, where we saw lots of businesses that were damaged. So these measures are over and above the tax proposals made in a 2021 budget in February. So as I said, they extend the employment tax incentive, which is a deduction that employers can claim. Normally, it's I forget, but I think it's up to age 29, Chris.
Yes, that's
Why
right.
am I? Yeah, 29. But now we've extended it to all ages, as long as the employee is earning below 6,500 Rand a month. and we've done it for 4 months. It's also slightly more than what they would get, because this deduction normally goes down in the second year, but we'll explain that in a bit more detail when we get to it. And then we've extended, we've extended the deferral on the payment against the employee's tax, mainly PAY, the personal income tax, for tax compliant small and medium businesses. So this with a turnover of less than 100 million rand, which is allowed. So they delay about 35% of their PAYE liabilities, which they normally give over to SARS. They can do that without penalties, but I should explain it's a deferral. So they got to still pay it later. And then there's a deferral of excise duties on alcohol beverages. These generally are done up front, and they've also been, we've allowed the industry to delay them. As you know, that the sale of alcohol was not allowed during the height of the third wave. Move on. Chair, I would just like to make one point that, you know, it's been quite a, next slide. It's been quite a battle. It's been, okay, this just outlines the normal legislative process, what I've sort of explained, that we then finally, normally at the end of July, put up the tax proposals. This year we were slightly late, so they were published on our website for public comment. But can I just make the point that I just want to pay tribute to one of our colleagues, Dr. Henny Lambrecht, who normally would do all the legislative drafting to oversee it, who unfortunately passed away after the budget. And we just want to pay tribute to him for this presentation today. It did mean that with Henny not being with us anymore, it did make the work for the team, particularly younger, quite difficult. So we'd just like to pay tribute to Dr. Lambrecht. Anyone want to take over these slides? Younger, do you want to just explain the process? I know I normally do it, but I'll leave it to you.
Okay, there are two processes that, good morning, Chair, good morning, everyone. There are two processes.
The video, is the computer not yet upgraded?
I don't know.
Yes,
The computer was updated, but I can't switch on the video due to challenges before technology. I'm trying, so I tried. So in terms of the legislative process, the emergency tax measures, we published, because we've already published the first batch dealing with the budget proposals on 28 July. So on 12 August, we published the second batch of the TLAB dealing with emergency tax measures. This second batch of the TLAB is amending the Disaster Management Tax Relief Act and Tax Administration Act. So what is going to happen is that we've got these two batches of tax bills, but now when we're doing the parliamentary process, we're going to do as one batch as we are dealing with today. And then when the minister tables the bills in October during MTBPS, is going to only table one set of tax bills. That is, it's not going to table the first batch or the second batch. And the reason why we did the second batch is that by the time we had to do the emergency tax measures, the first batch of the draft TLAB had already been published. So this is just the legislative process for emergency tax measures. So maybe during the parliamentary presentation, you're going to see the first batch which deals with the budget proposals and the second batch which deals with emergency tax measures. But when we table the bill later in the year, it will be one set of tax bills. Thank you.
Okay, I think I've been through all of this. Let's get to the bill itself. Okay.
Okay,
Chris,
shall
you
I
want
do
to
the
talk
rates
through? Yeah.
Yeah, thanks. Good morning, Chair. Good morning, honourable members. I'll just go through the components of the rates bill. So the rates bill includes all the changes to thresholds and other rates that were announced in the budget. A lot of them became effective either immediately or very soon after, but we did publish a draft legislative bill on the same day as the budget, and this is what's before you today as well. So just to give a quick recap on the 2021 budget, there was a projected 213 billion shortfall, but it was quite a big improvement from the NTBPS forecast on revenue on the back of a stronger expected recovery. So we had previously announced a 40 billion increase in tax over 3 years. Because of the improvement, we then withdrew those tax increases, and we put in measures that weren't going to raise any additional revenue, although there were some elements which provided some tax relief and others which offset that through slightly higher tax revenue. So the main proposals were for personal income tax relief with an above inflation increase in the brackets and rebates. We also increased the general fuel levy by 15 cents per litre, which was in line with inflation, and the RAF levy slightly above inflation at 11 cents, and there were higher than inflation increases on alcohol and tobacco. If you look at the, this is the table that we publish in budget. The top line, let me see if I can get a pointer. The top line shows that we weren't expecting to make any additional revenue. By changing the brackets and rebates and personal income tax by more than inflation, we were providing about 2.2 billion in tax relief. And this was offset by the increases in excise duties on alcohol and tobacco and the introduction of the export tax on scrap metal, which came into effect this month. This was just one of the charts from the chapter alongside our rationale for why we provided a small amount of personal income tax relief. If you look at the red dots in the figure, those are upper middle income countries like ourselves. At the bottom is the percent of personal income tax that the country pays as a percentage of GDP. And on the left is the top marginal income tax rate. So we're that red dot in the top right-hand quadrant. So we've got quite a high share of personal income tax as a share of GDP and quite a high top tax rate. And that's from a lot of the personal income tax increases that we've done over the past 6 years or so. And in this budget, we try to provide a small amount of tax relief. So if you look at the actual bill in terms of the rates bill, we need to then make adjustments to all of these figures in this table. So in the table on the left-hand side is what it was for the year 2020, 2021. And if you look at the right, that's how it's been adjusted. So I think there were a few questions on this last year in this briefing, but so all those brackets increased by an amount of 5% on average. And then you can see it's across the board, those 5%, as well as the primary, secondary, and tertiary rebate, which are at the bottom there. So that in effect increases the tax-free threshold, which I think you can see from 83,100 to 87,300. So anyone earning below that amount wouldn't pay tax if they're below the age of 65. And for those above age of 65 and above the age of 75, it's those thresholds have also been increased. So the expected inflation rate was 4.2%. So that's normally how we baseline whether we wouldn't make any additional revenue or not. So if we didn't make any changes, the government would have raised an extra 11.2, but then by increasing by 5%, we provided relief for 2.2. There was also an inflation-related increase in medical tax credits from 319 per month to 332 per month for the first two beneficiaries, and 215 to 224 for any additional beneficiaries, which is in line with inflation of 4.2%. We do publish a table to try and show the impact across different income groups. If you can see in the second last column, the majority of the relief that we provide is on middle to lower incomes. And if you look at the very last column in terms of who pays the tax, you can see we do have a very progressive personal income tax system where the majority is paid by those on higher incomes. On the excise duties on alcohol and tobacco, we follow a policy where we try to target a tax burden, an excise duty burden for wine, beer, and spirits of 11%, 23%, and 36% of the weighted average retail selling price. and the targeted excise burden for tobacco is 40%. Now, we've been above those percentages for a few years after a number of increases. We've tried to state that this really is a policy guideline. It's not a legislative requirement that it needs to be exactly 11, 23, or 36. And we have, again, raised these excise duties by an amount slightly higher than inflation, quite a bit higher than inflation at 8%. So we recognize that it will be above those policy guidelines. And that's why we also did state in the budget that we will be reviewing those policy guidelines by doing a thorough alcohol and tobacco excise duty review that is ongoing. We also, in the rates bill, there was an increase in the carbon tax rate. This is included in the Carbon Tax Act because it does say that it should increase by inflation plus 2%, CPI plus 2%. So it is automatic, but it's also put into the rates bill to finalize it with an increase from 127 Rand to 134 Rand per tonne of carbon dioxide equivalent from 1 January 2021. So there are a few other measures in the Chapter 4 that aren't in the rates bill that are done through regulation. So the increase in the fuel levy and the RAF levy of 15 cents, 11 cents is done elsewhere. In the second bullet, that should say the carbon fuel levy is also increased by 1 cent to 8 cents per litre and 9 cents per litre. That's done in the same regulations as the General Fuel Levy and Road Accident Fund. We also increased the minimum value for paid up annuity, retirement annuities from 7,000 to 15,000 to help individuals who needed those funds during COVID. We also aligned the UIF benefit ceiling and introduced a reduced levy rate of 12.5 cents for bio-based plastic bags. And then I think that will cover all the issues in the rates bill, which you can see on a clause by clause in that slide. Thanks.
So Chair, that's just the rates bill. As you can see, and honourable members, that it's that bill, as I said, only deals with the rate changes and the threshold. So it's normally what we say is in Chapter 4 of the budget review, where we announce the changes to the personal income tax tables and where we change the brackets. And if we were to increase or decrease the rate, then it would feature. Obviously, if there's no change in the tax rate, like VAT remains, say, at 15%, we don't have to do that every year. It just, so these are only the changes on the rates and thresholds. Okay, so Chair, we'll now go on to the more substantive bill, the TLAB, which deals with all the more complex issues around tax changes. The tax changes, of course, are not restricted to rates and thresholds, but also to change in a tax base. There's many anti-avoidance measures. So it gets into substantive legislative changes and changes your key acts that apply to taxes, like the Income Tax Act or the VAT Act, etc. Okay, who's going to start off?
Thank you, Mama. I will start off and Chris will chip in. As Mama has indicated, the draft TLAB deals with more substantive changes. Sometimes we clarify the law so as to assist taxpayers. Sometimes we clarify the law so as to close loophole and curb anti-avoidance. So this is the most contested part, of which most tax practitioners, like you'll see the accounting firms, when they come for the public hearings, they'll be dealing with the more issues that are included in the draft TLAB, more especially the anti-avoidance measures. The first one of the draft TLAB is the reviewing the nature of long service hours for fringe benefit purposes. In this one, we are assisting taxpayers. Currently, we all know that employers do grant long service hours to employees who have been at work for a longer period of time. So the income tax allows employees to grant long service hours to an employee, and then there is no taxable benefit if the long service hour does not exceed 5,000 Rand. And that long service hours is a non-cash benefit. Hence, you'll find that employees are normally given watches and certificates, because you find that the employer wants to stick within the purview of the income tax system so that there is no taxable fringe benefit when the, say, long service award is given to that employee. The long service is a long service if it's the unbroken period of 15 years. So it has come to our attention that the current prevailing practice is for employers to grant their employees a wide range of awards in recognition of long services. So now it is not limited to non-cash benefit. You find that someone will be given a holiday or will be given vouchers. So in order for us to recognize the current prevailing practice, it is proposed that changes be made in the Act so that the current provision as relates to long service awards are not only limited to non-cash assets, but rather extend to apply to other reasonable awards granted for long service. But that said, the current limitations will apply. For example, it should be granted if the employer has been on an unbroken period of service for 15 years and does not exceed 5,000. So those limitations will still apply. I know that maybe in the coming years, they're gonna come and say the 5,000 is too low, but the current limitation will still apply, except that it is extended to cover other non-cash benefits, other non-cash assets. Thank you. The next slide. Chris, ATI.
Sorry, I was struggling to unmute there. Okay, thank you. The next one is on curbing abuse in the employment tax incentive. So the employment tax incentive was introduced in 2014. It, as Momo said earlier, it tries to help with the hiring of the youth between the ages of 18 and 29 by providing a reduction in pay as you earn for companies if they earn less than 6,500 Rand per month. We've seen some schemes that are taking place in the industry where companies are claiming the ETI and respective individuals who just go to training programs and don't actually work for the employer. And it turns out that the amount that the employer pays the individual is exactly the amount that then goes to the training institution. So the individual actually doesn't get anything, but just attends a training program. And this really wasn't in line with the scheme. You know, it's not actually employment. That person isn't actually working for that employer. They're just going through a training authority. So to try and correct this issue, we're proposing changes in the legislation that says that work must actually be performed so that it's in line with Section 1.1 of the Employment Income Tax Act, Employment Tax Incentive Act. And they must be documented and keep employer records like they would with other employees along the lines of the basic conditions of Employment Act. So hopefully this will stop these schemes because we don't think it was in line with the original incentive, and it has been put forward to be implemented from the 1st of March 2021.
Thank you, Chair. The members will note that in cases where the dates are retrospective, for example, the previous ETI, we have put the effective date. So I think there are about 3 or 4 of the proposals whereby the effective date are retrospective. And we know that when the taxpayers come to Parliament, they normally complain about the effective date. So on the ones that are controversial, that is when the effective date is retrospective, we've already indicated the effective date that is retrospective, for example, the ETI. The next slide is clarifying the timing of disposal rules.
But Yanga, just to be clear, because there's different types of retrospectivity, the retrospectivity that we have, firstly, is always, well, we try and minimize those, but almost all of them will tend to be after the announcement, but before the legislation is enacted. So in other words, if the minister makes the announcement in February, it may take effect, for example, on the 1st of April. And when this legislation comes, it's already July. Is that what you mean, right?
Momo, that's what I mean.
Yeah, so it's retrospective after the budget. It's even though it's retrospective, it's not retrospective from in terms of the announcement. It is all after the announcement, but before the law actually gets enacted.
Yes, it's before the law actually gets enacted. Next one is clarifying the timing disposal rule in respect of an asset acquired from a deceased estate. This one is assisting taxpayers because it clarifies when the heir is required to get an asset from the estate of the deceased. So when a person dies, the Estate Duty Act makes provision for the asset to be transferred to the estate of the deceased before the assets are distributed to the heirs. So this now is governed by the Estate Duty Act, which makes provision for the liquidation and distribution account and make provision for the appointment of the executor of the estate. Legally, the L&D account must remain open for inspection in the Master of the High Court for 21 business days. And once the liquidation account is finalized, the heir can claim their personal right for the delivery of assets from the estate. So now, what is not clear is the timing around when the heirs are regarded as having acquired an asset from the estate of the deceased. So that has been the question for clarification that has been asked by the heirs. So in order to clarify the timing of disposal of the heir's personal right to claim the delivery of the deceased estate assets, it is proposed that changes be made in the law so that the disposal of assets by the estate occurs on the date in which the L&D account becomes final. Next slide. Tax treatment of a cession of a right to receive an asset. So now, this proposal is aimed at curbing abuse. So this is an anti-avoidance measure whereby some taxpayers are undermining the donations tax provisions. Currently, the Act makes provision for donations tax to be levied on the value of any property disposed of, whether directly or indirectly under any donation by any resident. However, it has come to our attention that some taxpayers have devised certain schemes that undermine the donations tax. For example, this happens in the way of an independent contractor or an employee, whereby that independent contractor will receive the right to receive a salary from the person to whom the services are rendered. And the right to receive the asset is generally ceded to a family trust before the services are rendered. So here is the independent contractor will contract to do services for that particular person or an employer, but will cede the right to receive the salary in his or her own name, and that salary will go to the family trust. In order to address these types of schemes, it is proposed that changes be made in the Act to clarify that in these instances, whereby a right to receive an asset is ceded, then they will be deemed disposals and the donations tax will apply. So the fact that you have ceded that right, we're gonna disregard it, and then we will deem for the donations tax to apply. Next one. The one is strengthening the anti-avoidance rules in respect of loan transfers between trusts. These rules were first introduced in 2016, but the members will find that each and every year or after 2 years, we make provisions to counter the anti-avoidance. And these rules were anti-avoidance measures that were aimed to curb the tax-free transfer of wealth to trusts using low interest-free loans. But after we have introduced these rules, taxpayers are finding further schemes to curb or undermine these measures. So now we made changes in 2017, we made changes again in 2020. So again in 2021, there are proposed measures again in terms of these rules, because we have seen some taxpayers, they continue to undermine these measures by transferring loans which finance high value assets between trusts, where the founder of one trust holding the original asset is related to one or more beneficiaries of the other trust to which the loan asset is transferred. In order to close this, it is proposed that further changes be made to the legislation to ensure that these anti-avoidance measures also apply in respect of any loan, advance, or credit that a trust directly or indirectly provides to another trust in relation to which the founder and the beneficiaries are connected persons. In view of the fact that the proposed measure is aimed at curbing further abuse, this is another provision whereby the proposed amendments apply retrospectively before the Parliament passes the legislation. So it is proposed that they apply retrospectively from the date of the publication of the draft TLAB for public comments, which is 28 July 2021. So this is another one. This is the second one, because as we have said earlier, if we are trying to stop abuse, and we've been amending the rules almost every year, we make the changes retrospectively. Next slide. Okay, Chris.
Thanks. So this is the tax on the retirement interest when an individual ceases to be a tax resident. So at the moment, if you contribute to a retirement fund, let's say, for example, a retirement annuity fund, and then you cease to be a tax resident and you go to another country, we changed the rules last year that an individual would then need to wait for 3 years of not being a tax resident, and then they can take their money when they leave, after they've left. This is different to individuals who stay a tax resident, who can only receive that money when they are aged 55 and over. But then if they were to take that money, that amount, according to the double tax agreements, might not be taxable in South Africa at all. So individuals would have received a full upfront tax deduction on the amounts going into the retirement fund. They would have received tax-free growth on the investments within the retirement fund, so no capital gains tax, dividends tax, interest tax. And then when they leave the country, they wouldn't be paying any tax either. So this really does get rid of our taxing rights on those types of assets. So we're trying to fix that. And the proposal we are saying is that when an individual ceases to be a South African tax resident, we will deem a tax to be paid on the day before they cease to be resident, but we do not actually ask for the tax to be paid at that time. So it can be deferred. It's the same regime or the same treatment that you do for capital gains tax. So if someone ceases to be a tax resident, they would pay capital gains tax on their worldwide assets the day before they cease to be tax resident, so that in effect you can keep your taxing rights. So we're following a two-pronged approach, both for withdrawals and for amounts taken on retirement. So if an individual were to withdraw before retirement or death, the individual would have been deemed to have disposed of that interest on the retirement fund the day before they cease to be a tax resident. And then the interest will form part of the assets of that individual, and they won't need to make a payment. However, if they do actually make a withdrawal after, say, 3 years of being a non-tax resident, then they will need to be paid the tax that was applicable on that amount on the day before they ceased, using the prevailing withdrawal tax tables at the time, plus interest. So in effect, we are trying to recoup the tax that would not be paid at the current in the current situation if that person were to go offshore for longer than 3 years. And then this will apply in effect from the day before they cease to be a tax resident, and then the tax would be paid. A similar situation would occur for if they then go offshore, but there is a lump sum on retirement or on death. So if there is also a lump sum can be paid then, but there is a different tax table for lump sums on retirement or death. So now there will be a deemed amount to have been disposed of the day before they cease. And again, once they get to the point where it's actually withdrawn or being paid to the individual, that tax would then be due. If an individual were to come back to South Africa and become a tax resident again, there would be a tax credit that would be provided for, and in effect that deemed tax would fall away, and the original withdrawal tax tables or retirement lump sum tax tables would apply. So they would be in no worse off position if they were to go offshore or become a non-tax resident and then come back later and then only withdraw at that time. It would be no change for them. But for those who tried to withdraw while they were a non-tax resident where we don't have taxing rights, this deemed tax would apply from the day before. Another one is allowing a bit more flexibility for annuities. At the moment in the legislation, if you contribute to a retirement fund, when you retire, you're required to annuitize up to 2/3 of that amount to purchase an annuity. You can use up to 1/3 as a lump sum that you can take immediately, but the remainder must then be used to purchase an annuity, and it can be done through a number of ways, either directly through the fund, through a South African registered insurer, or through the fund and a South African registered insurer. But at the moment in the legislation, you're only allowed to purchase an annuity, one annuity. Now, this isn't incredibly flexible. There might be some cases where an individual would like a living annuity or a guaranteed annuity where you get a particular amount per month for the rest of your life, but they'd also like to perhaps purchase a living annuity where you can invest and then withdraw between 2.5% and 17.5% of that amount each year. So we're trying to increase flexibility here by saying that an individual can purchase more than one annuity here at retirement. They can still take their 1/3 as a lump sum, but the other 2/3 they can then split between annuities. Now, we don't want to have a split between the annuities that then they try and get around our rules about lump sums. So we're also putting in a minimum amount of 165,000 Rand so that they can't split those annuities and then take a much bigger lump sum. So that should be able to circumvent that issue. And we also wouldn't want annuities to be purchased with too small of a value anyway, as they, the excessive costs do not make it very cost effective. Another proposal that we're trying to do to make the market a bit more flexible is to allow for tax-free transfers between preservation funds. So the policy here is that we would like tax-free transfers between funds as long as it's not to a fund with a less restrictive criteria, i.e. one that you can withdraw funds more easily than in the previous fund. So at the moment, there is a small edge case where you might have someone who has an amount in a pension preservation or provident preservation fund, and they've gone past their normal retirement age for the rules of the fund, but they haven't yet elected to retire. So a few years ago, we changed the law to say that even if you get to your normal retirement age, you don't actually need to take the amount. You can elect to retire later so that you can preserve the amount for longer. And in this little edge case between that period, there's no tax-free transfers available if you transfer between preservation funds. So this is just to allow that so that there's more flexibility and people can move between those funds, and hopefully industry can consolidate and lower costs. There's another relatively technical amendment on contribution certificates. So for defined benefit funds, we also changed the legislation a few years ago to change the fringe benefit to the value of the contribution. So defined benefit funds aren't linked to a specific contribution. They're linked to, say, for example, your years of service and your age. And we now value the additional amount that you get each year, and you pay fringe benefit tax on that. There are certificates that the actuaries need to provide to show what that value is. And there is a case where you have a defined contribution fund where the amount that goes into the fund is just the amount. That's your investment amount that can then grow or not. But also there are risk benefits that are part of that package. And in this case, if there was a self-insured risk benefit, i.e. the fund insured that risk benefit themselves for death or disability, an amount of your contributions would go to that self-insured risk benefit. But currently in the legislation, you would still need an actuary to then determine that value based on the valuation. But there isn't actually a need for that because there's an actual specific amount that is paid that covers that risk benefit that could then be used with third parties, for example, after it's, the fund was insured, take another step to insure outside of the fund. And that specific value doesn't need a valuation because it's actually just that value. So we're addressing that so that a lot of funds now don't need to do those valuation certificates, which would reduce the administrative requirements of this provision. Thanks.
Now we are coming to the business tax. With regard to the first two proposals, we have to go back to the 2020 budget, whereby the minister stated that government intends to restructure the corporate income tax system in a revenue neutral manner. And this requires the broadening of the tax base, whereby you limit the interest deduction as well as assessed losses. So the first rules deals with the limitation of interest deductions, whereby we strengthen these rules because currently the Income Tax Act have got these rules, and these rules were introduced in 2013 and were effective from 2015, whereby they deal with the limitation of interest in respect of debts owed to persons not subject to tax. Persons not subject to tax in this regard mean exempt persons as well as non-residents, because non-residents are not subject to tax in South Africa. It is important to note that when you say persons not subject to tax because of discrimination issues relating to tax treaties, even if you wanted to make the rule only applicable to non-tax residents, the discrimination issues in terms of tax treaties will not allow you to say that. Hence, you'll find that in these provisions, we have a general rule to say persons not subject to tax because we cannot say non-residents of the country. So the main aim of these rules is to limit excessive interest deduction in respect of debts owed to persons not subject to tax in South Africa if the debtor and the creditor are in a controlling relationship. So these rules were introduced in 2013. So come the BEPS OECD project. So this BEPS OECD project made a review of these rules, and Action 4 deals with these rules. So this implies that almost each and every country have got these rules. So in February 2020, we published a discussion document whereby we wanted to review these rules so as to be in line with Action 4 of the OECD BEPS project. So during our review, after we published the discussion document, last year, we had public workshops and we received comments on the discussion document. So the proposals that are included in the draft TLAB as a result of the work that was conducted last year. So now we did the first round of comments on the discussion document. Now we'll be doing the second round of comments on the proposals that are included in the draft TLAB based on the discussion document. So during the review and the discussion document, the following issues were highlighted as problematic. For example, the first one was the meaning of the term interest for the purpose of these rules. The review highlighted that the meaning of the term interest for South African purposes is too narrow, as it does not cover other payments that are disguised as interest for anti-avoidance. The second issue was, so please go to the previous slide, was deductible interest limitation, the formula calculation. The review found that South Africa is the only country that is an outlier that used the formula calculation. Other countries do not use any formula calculation for determination of interest limitation. And secondly, the formula calculation for South African purposes was the interest rate was based on the repo rate by the Reserve Bank. So we were the outliers in that scenario. And thirdly, it was determined at 40% of adjustable taxable income. And in 2014, before these rules were introduced in 2015, we did changes. And then it was found that the 40% may be rather too high. But we noted in the response document that this 40% will be looked at a later stage. So now it is the time to look at that 40%. The third one was the back-to-back loans. It has come to our attention that there are back-to-back loan lending arrangements, which are often entered into by a chain of companies that are in a controlling relationship with each other, and the fiscus ends up losing interest deduction. So, because these back-to-back loan arrangements are entered into so as to avoid tax, or so as to increase the interest deductions. So even though currently we have the provision in Section 23M dealing with back-to-back loans, however, our provisions are not wide enough. The next one is definition of adjusted taxable income as it applies to REITs. Currently, we all know that REITs the distribution of a REITs, it qualifies for a deduction. This means that if the distribution of a REITs qualify for a deduction, then we have to take it into account in the definition of adjustable taxable income, because if we do not take it into account, it will increase their adjustable taxable income. The last one was interaction between the level of withholding tax on interest in terms of tax rates and Section 23M rules. As we have said earlier, Section 23M applies to interest not subject to tax, to those persons not subject to tax in South Africa. So it may happen that the interest is payable to a person whereby South Africa has got a tax treaty with that particular country, maybe we can say UK, and the interest withholding in terms of the tax treaty is reduced from 15% to 5%. So in that scenario, in other countries, the interest is reduced to 0. So in that scenario, the interest is not subject to tax because of the reduction of the tax treaty. The next slide. So after we have made this review, in this 2021 draft TLAB, we are coming with the proposal based on the discussion document. So in order to address these above mentioned issues, the following changes are proposed in the Act, that is in Section 23M. The first proposal is to widen the meaning of the term interest for the purpose of these rules. So this implies that for the purposes of these rules, the meaning of the term interest will be expanded beyond the current definition of interest contained in Section 23J to include the following payments that are disguised as interest but not covered under Section 24J, that is payments under interest rate swap agreements, finance cost element included in finance lease payments, and foreign exchange differences. So meaning that for the purpose of Section 23M, the term interest will be expanded to include all these payments. And secondly, changes will be made on the formula calculation. The proposal is that the deduction of interest expenditure should be limited to 30% of adjustable taxable income instead of the current 40% calculated percentage of adjusted taxable income. As we have said earlier, that in 2014, when we made changes to these rules, it was found that the 40% is too high. So now the 40% is reduced to 30%. In addition, the part of the deduction formula which adjusts upwards and downwards based on the average repo rate for the year will be deleted. As we have said, that South Africa was the outlier because it has got a formula that adjusts upwards and downwards based on the Reserve Bank repo rate. Further consequential amendments are to be made in Section 23N, of which Section 23N apply to loans, to interest payments between companies within the group of companies in the country. Next slide. The next one is back-to-back loans. As we have said earlier, that even though the current rules of Section 23M have provisions applicable to back-to-back loans, but the current provisions are limited, and in that taxpayers do circumvent these provisions. And the nice part is that this example was given by one of the taxpayers to say during the review, they gave us this scenario to say that the current rules do not address this scenario. So it is proposed that changes be made in the current provision so that interest limitation rules apply in instances where a debtor incurs an amount of interest owed to a creditor that is in a controlling relationship with that debtor. If that creditor directly or indirectly, those are important words, through another creditor that is in a controlling relationship with that creditor, obtain the funding for the debt advanced to the debtor from a person that is in a controlling relationship with that creditor. So this is the words directly or indirectly here are important because according to the structure that was given to us during the public workshop on this, it was showing that there is a chain of schemes whereby these will be done indirectly. The next one is refining the amount of interest deduction for REITs. Here, as we have said earlier, is to take into account that distribution for REITs are tax deductible. So it is proposed that a change be made in the definition of adjustable taxable income to add back the qualifying distribution of a REIT so that the REITs are not put in a worse off position. The next slide. The last one is interaction between the level of withholding tax on interest in terms of tax treaties and application of Section 23M. In this regard, it is proposed that changes be made in the Act so that there is more consistent treatment for all resident debt payers paying interest so that the restriction is not dependent on which the country the payment is routed through. So this takes into account whereby the withholding tax on interest is reduced to 0 or 5% because of the tax treaty. The next slide. So the second rule whereby we are broadening the tax base is restricting the balance of assessed losses in determining the taxable income. Currently, the rules in Section 20 of the Income Tax Act make provision for taxpayers to set off their balance of assessed losses carried forward from the preceding tax years against their taxable income. And any unutilized balance of assessed losses may be carried forward to future years of assessment to be set off against future income. It is important to note that when we are doing this OECD BEPS project, because we also sit on the steering group, South Africa is the only country that does not have limitation. Other bigger countries have got limitation because with us, the balance of assessed loss can be carried forward for future years. Other countries have got limitation of up to 7 years. And then the first in, first out rule will apply. In South Africa, there was no limitation regarding the balance of assessed losses. The next slide. So as to improve the country's competitiveness and to reduce the appeal of base erosion and profit shifting, as previously announced by the minister in the 2020 budget review, the following proposals are made in terms of the assessed losses. So what we are proposing is to have some sort of a restriction because other countries have got a limitation in terms of percentages that can be carried forward. Other countries do limitation in terms of the years, maybe to have 7-year restriction. And as I've said earlier, South Africa does not have any limitation whatsoever. So as long as the company is trading in South Africa, you can carry on the balance of your assessed loss as long as the company is trading. So as to have some sort of a limitation, government proposes to broaden the corporate income tax base by restricting the set-off of the balance of assessed loss carried forward to 80% of taxable income. So meaning that only it will be reduced to 80% of taxable income. So here in South Africa, we're choosing another form of restrictions, whereas other countries are choosing other forms of restriction in terms of the year limitation. This proposal extends to the balance of assessed losses at the time of the implementation. That is, it is not only the accumulation of losses starting from the date of implementation that will be subject to the new rules. And this will contribute to provide the fiscal room for government to lower the corporate tax rate. Next slide. So those slides, the first two proposals are aimed at broadening the base and lowering the rate. So now we are coming to other sets of proposals. The next one is clarifying the definition of contributed tax capital. This one is an anti-avoidance measure proposal. Currently, the Income Tax Act have got a notion called contributed tax capital, and it was introduced in the Income Tax Act in 2008, when in South Africa we revamped the Companies Act. So this term of contributed tax capital came from the Companies Act. And it means the contributed tax capital of any company is a notional amount which is ring-fenced, and it is derived from contributions made to a company by holders of a class of shares as a consideration for the issue of that class of shares by that company. This amount is reduced yearly or periodically by a capital amount that is subsequently transferred back by the company to one or more shareholders of that class of shares. So it is important that if we are shareholders holding a certain class of shares, then in terms of the notion of the contributed tax capital, there should be equal treatment. The policy rationale of this provision and the wording of the current proviso to the definition of contributed tax capital specifically requires that no holder of a shares within a particular class of shares may receive CTC in excess of an amount per share derived by dividing the total CTC by the number of shares in that class immediately before that distribution. That's what I said earlier, that if we are shareholders holding a certain class of shares, there should be equal treatment. However, it has come to our attention that some companies are exploiting the current provisions by allocating CTC on the basis of an alleged share premium contributed by that particular shareholder, but not to all shareholders holding shares in that same class of shares. So that's where the avoidance is coming, because the rules require all the shareholders holding shares in that particular class to be treated equally. But now companies are coming with these schemes. In order to close this, it is proposed that changes be made to the definition of contributed tax capital to clarify the principle that shareholders within the same class of shares should share equally in the allocation of CTC as a result of a distribution. So this is a clarification of the current policy rationale. We are not changing anything, but we are clarifying so that the rules are clear, so that there is no anomaly as a result of the interpretation of the rules. Next slide. Limiting potential for double taxation under hybrid debt anti-avoidance rules. Currently, the Act contains hybrid debt anti-avoidance rules aimed at capping artificial generation of interest deduction by an issuer if the debt instrument qualifies as a hybrid debt instrument, or if the yield is determined not to constitute bona fide interest. These rules characterize interest labeled returns as dividends in specie paid in respect of a share. The rationale for recharacterizing interest as dividend is that dividends are not tax deductible and they are subject to a dividend withholding tax, whereas interest is tax deductible. So concerns have been raised that the deeming provisions which deem any return from tainted debt instrument or any tainted returns to be dividends in specie in respect of a share to be declared and paid by the issuer to that person to meet the amount accrued do not specifically deem the return to be the accrual of dividends in specie for the holder or recipient of the return. As a result, the return may not qualify for an interest deduction, and dividends may be taxable by the issuer if no exemption apply on the holder. And such a result will be too draconian, as the return will be regarded as interest and thus also be taxable for the holder of a tainted instrument or recipient of a tainted return, leading to economic double taxation. Because in this scenario, it will be regarded as a dividend in specie as well as interest. In order to close this anomaly of economic double taxation, because this is not intended. So this provision is aimed at assisting taxpayers. It is proposed that changes be made in the law to extend the deeming provision to apply to the holder of a tainted instrument or recipient of a tainted return. In addition, consequential amendments are proposed to the tax treatment of the reclassified return for purpose of withholding tax on interest in terms of the Act. This proposal is assisting taxpayers, so there is no it's not controversial. The next one, clarifying the meaning of interest under the debt relief rules. The Act contained debt relief rules that trigger tax consequences in respect of a waiver cancellation of a debt owed by a taxpayer. In 2017, these rules were changed to ensure that the debt relief rules trigger a debt benefit that is subject to tax if the face value of the reduced amount of the debt prior to the entering into that arrangement exceeds the market value of the shares, or the amount by which the market value of the interest in the share held by the creditor in that debtor company after the implementation of that arrangement exceed the market value of the interest. So concerns have been raised regarding the meaning of the word interest in the debt relief rules. So when we made the changes in 2017, we referred to interest. However, we did not clarify what is the meaning of interest for purposes of these rules. So you find that the Income Tax Act interest is defined in Section 24J, but if each and every rule refers to interest in the Income Tax Act. This implies that there should be clarity as to the meaning of interest, whether you mean interest as defined in Section 24J, or you mean you're gonna define interest specifically for the purpose of the application in these rules. So in order to provide clarity as to the meaning of the word interest for purpose of applying the debt relief rules, it is proposed that the meaning of the word interest be clarified to mean interest as defined in Section 24J of the Act. Next slide. Refining the interaction between anti-value shifting rules and corporate reorganization rules. Currently, the Act has rules called anti-value shifting rules, which deal with the capping of the use of the structures to shift the value of the assets tax-free between taxpayers. And these rules are contained in Section 24BA and Section 40CA. Section 24BA applies to transaction that involves asset for share transaction and trigger CGT and also trigger distribution, which is subject to dividends tax if there is shifting of value between taxpayers tax-free. On the other hand, Section 40CA prescribes a base cost in transaction that involves assets for the exchanges if there is shifting of value tax-free. Thirdly, there is a third rule that applies, that is the corporate reorganization rules. So at issue here is the interaction of all the three rules. The rollover relief rules, which are available in the corporate reorganization rules, make provision for the tax-neutral transfer of assets between companies that form part of the same group of companies. So assets transferred in terms of the corporate organization rules qualify for a rollover relief of a base cost. It is important to note that South Africa has got these corporate relief rules because South Africa does not have what is called group taxation. So in order to provide relief when assets are transferred between companies that form part of the same group of companies, we've got what is called mini group rules, whereby the corporate organization rules make provision for the tax neutral transfer of assets, provided that the provisions are met. So starting from this slide up to the last slide in the business tax, it is the refinement of the corporate organization rules, because you find that during these difficult times, businesses use a lot of these rules so as to transfer assets between companies tax-free. Next slide. So the issue is the interaction between these three rules, that is Section 24BA, Section 40CA, and corporate reorganization rules. At issue is that the capital gain that is triggered in terms of anti-value shifting rules, that is in terms of Section 24BA and Section 40CA, is added to the base cost of an asset in terms of Section 40CA, which is outside the corporate reorganization rules. So this creates an anomaly in the Act. So the proposal is to rectify this anomaly. In order to rectify this anomaly, it is proposed that changes be made in the Act to provide for additional base cost equal to any deemed capital gain resulting from the application of the anti-value shifting rules for purpose of corporate reorganization rules. Next slide. Clarifying the rules that trigger additional consideration in asset for share transaction when a debt is assumed by a company. This is also the corporate reorganization rules. Currently, the corporate reorganization rules have got Section 42, which deals with asset for share transaction and allow for tax neutral transfer of assets when a transferor disposes of an asset to a company in exchange for the issue of shares in that company to that transferor. The example is that if the transferor transfers an office building to a company, but instead of company paying a consideration for money for the transfer of that office building in a company, in exchange, the company will issue shares to that person who transferred the office building in that company. So now the issue is when the office building transferred to that company in exchange for shares in that company is still indebted. If there is still debt owed in that office building that is transferred to that particular company in exchange for the issue of shares in that company. In order to curb the anti-avoidance, the rules make provision for an anti-avoidance measure, which provides that if a person transfers an asset to a company and that asset has got debt owing, the rules make provision that a proportional part of any qualifying debt that was assumed by a company as part of an asset for share transaction will constitute an amount received by or accrued to that transferor in respect of the subsequent disposal of any share in that company acquired in terms of asset for share transaction. So as to curb abuse, whereby the taxpayers will transfer an asset that is indebted in a company and not pay for that debt. These rules have got an anti-avoidance measure to say that the debt will accrue, the amount of debt owing will accrue to that transferor when that person subsequently sells the shares issued by that company. At issue is that the above mentioned anti-avoidance measure are undermined if the transferor subsequently transfers the shares to another company in terms of the corporate reorganization rules, as other applicable corporate reorganization rules will make provision for the rollover relief. So this implies that in year one, you get into an asset for share transaction and you transferred an asset that has got a debt into that company. However, in year two, you subsequently sells the shares that were issued to you by that company. However, you sell the shares through another corporate reorganization transaction. And when you use the corporate reorganization transaction, this implies that you will qualify for a second rollover relief. And the debt now will no longer be an amount owing to you. So the proposal is that, the next slide. So in order to prevent these rules from being undermined, it is proposed that the anti-avoidance rules should be amended so that the additional consideration accrues to the transferor in relation to any assumed debt immediately before any subsequent disposal of the shares acquired in terms of an asset for share transaction. So even if that transferor will be disposing of the shares in terms of the corporate organization rules, the debt will be assumed by that transferor. So we're not going to cancel the fact that you are using the corporate reorganization rules. The next slide. Clarifying the early disposal anti-avoidance rules in intra-group transaction. Section 45 of the Act deals with intra-group transactions and allow for tax-neutral transfer in respect of disposal of asset or a business as a going concern between companies that form part of the same group of companies. As indicated earlier, this takes into account that South Africa does not have group taxation. The intra-group, this Section 45 rule has got anti-avoidance measure, whereby if a person transfers the assets in terms of Section 45, but within 18 months, the asset is disposed of, then the anti-avoidance measure will apply. This anti-avoidance measure is called early disposal rule. For example, a company that is disposing of an asset within 18 months of acquiring it must ring-fence the resultant tax consequences of such disposal. That is, for example, the capital loss or the capital gain or the income. And this rule, the early disposals rule, the 18-month early disposal rule, forces companies to pay tax immediately, because this is aimed at stopping the abuse whereby you use Section 45 to transfer the assets between group companies tax-free, but within 18 months, you dispose of the assets that you acquired in terms of the intra-group transaction. So this rule is aimed at stopping the abuse of disposing of the asset within 18 months of such an acquisition. At issue is that in some instances, a capital gain may have been anticipated from the disposal of an asset on the date in which the intra-group transaction took place. However, at the date of the disposal of an asset within 18 months after the acquisition in terms of the intra-group transaction, a capital loss arises. The problem is that the difference in the nature of the resultant tax consequences, that is capital gain or capital loss, in respect of the disposal of an asset on the date of intra-group transaction and the date of early disposal within 18 months, creates an ambiguity in the application of the anti-avoidance rule. Because here we're looking at the two dates. The first date is the date in which the company, in which the taxpayer enters into an intra-group transaction. The second date is the date in which the taxpayer disposed of the asset within 18 months of such an acquisition. So in order to close this ambiguity, it is proposed that changes be made in the legislation to ensure that any capital gain or capital loss or income arising in the hands of a transferring company from an early disposal of an asset that was previously acquired in terms of intra-group transaction should be ring-fenced without regard to any capital gain or capital loss arising on the date of intra-group transaction. So this implies that when the asset is disposed within 18 months of the acquisition, the resultant the resultant amount, which is the capital gain or capital loss, will be ring-fenced and will have no regard of the resultant capital loss or capital gain as a result of the intra-group transaction. So the two dates, the income derived as a result of the two transactions entered at different scenarios. That is, the first one will be intra-group, the second one will be 18 months disposal. So there will be ring fencing of that income. The next slide. The next slide. Extending the reversal of the nil-based cost rules to apply on the 6th anniversary of intra-group transaction. This also deals with section 45, which deals with intra-group transactions, whereby there is tax-free transfer of assets or businesses between the same group of companies. As previously stated, these intra-group rules have got anti-avoidance measures. In this scenario, for the purpose of this proposal, there are two anti-avoidance measures that are at play. The first one is the degrouping rule, and the second one is the zero-based cost rule. In terms of the degrouping rule, the degrouping rule reverses any tax benefit if a transferor company ceases to form part of the same group of companies within 6 years of the original transaction. So this implies that if you entered into an intra-group transaction using these rules and you derived a tax benefit, this implies that you must stay within the group for the next period of 6 years. You must be locked in. So if you cease to form part of the group of companies, then the tax benefit will be reversed. The second rule, which is the zero-based cost rule, applies to a holder of any debt or non-equity shares issued by a fellow group company if that debt or non-equity shares was used to facilitate or fund the intra-group transaction. So these are anti-avoidance measures that are available in terms of these rules. In 2020, changes were made in section 45 to remove the potential double taxation arising in instances where intra-group transaction is subject to a zero-based cost for the holder of a debt or non-equity share that facilitated or funded an intra-group transaction. And the subsequent degrouping occurs, and the degrouping rule reverses the tax deferral benefits. So last year we made changes so as to remove any anomaly. So now the issue is the following. In view of the fact that the degrouping anti-avoidance rule ceases to apply on the 6th year of the intra-group transaction, the zero-based cost anti-avoidance rule should cease to apply on the 6th year of intra-group transaction. So here we are synchronizing the years to say that if the degrouping ceases to apply on the 6th year, this implies that the zero-based cost rule should cease up to apply on the 6th year also. So it is proposed that changes be made to ensure that the base cost is restored for holders of a debt or non-equity shares used to facilitate the transfer of assets in terms of intra-group transaction on the 6th year of the intra-group transactions. So here we are synchronizing the 6th year anniversary that is applicable on the degrouping rule to apply on the zero-based cost rule. The next slide. Clarifying the interaction between early disposal anti-avoidance rule and nil-based cost rule in section 45. So this is almost similar to the last slide, but here we are dealing with 3 sets of anti-avoidance. The first set is the degrouping rule, the second set is the zero-based cost rule, and the third set is the early disposal rule. So the issue is the interaction of the rules. So it came to our attention that in view of the fact that the early disposal rule reverses the tax deferral benefit in respect of the disposal of an asset which was acquired in terms of the intra-group transaction within 18 months of such an acquisition. So here, the taxpayers brought it to our attention that it is appropriate that the zero-based cost anti-avoidance rule should be reversed when the early disposal rule is triggered. So here also, this rule is assisting taxpayers, whereby we are synchronizing all the interaction of the 3 anti-avoidance measures. The next slide, the unbundling. Refining the provisions applicable to unbundling transaction. You remember that last year, we did changes in the anti-avoidance measure dealing with unbundling transactions. And last year, the changes that were made, we were excluding any distribution to disqualified person to make provision for the rollover relief not to apply in respect of any equity share that is distributed by an unbundling company to any shareholder that is a disqualified person and holds at least 5% of the equity shares in the unbundling company immediately before that unbundling transaction. Next slide. The changes that were made in 2020 resulted in the pro rata application of the anti-avoidance rules. And they were more equitable because we argued here in Parliament that the pro rata application is more equitable in respect of unbundling transaction, as only shares distributed to persons that are not disqualified persons will benefit from the rollover relief, and the rest will be subject to normal tax and dividends tax rules applicable on distribution. You remember that last year, there were lots of comments during the processing of the TLAB. However, the comments were coming on the fact that we were taking away the relief. They were not addressing the issues that we are addressing this year. And during our December workshops, when we're taking comments for the proposals to be included in the TLAB, it was when the last year's comments that were submitted in Parliament were refined. That is where we got to understand the real issues that the taxpayers were complaining about. And the issue was that the anti-avoidance measure dealing with exclusion of distribution to disqualified persons may be applied broadly, as the current wording in the legislation may be applied to limit expenditure incurred by a taxpayer in respect of any share held in an unbundling company, irrespective of how such a share in an unbundling company was acquired by that taxpayer. Next slide. So there are 2 proposals that we are proposing this year. The first proposal is to refine the amendments that we made last year. As I've said earlier, that during the comment stage and the public hearings, they came with a lot of comments in Parliament. However, we only get to understand their comments when we're doing the 2020 workshops for the proposals to be included in the 2021 draft TLAB. That is when all their comments and when the proposals were refined. So hence this year, we are making further changes to the last year's changes so as to make the rules more flexible. The first proposal is that it is proposed that changes be made in the rules that were made in the 2020 changes, so that shareholders in an unbundling company that qualify for tax deferral for an unbundling transaction should receive additional base cost that is reflective of the tax paid by the unbundling company in respect of their shares in the unbundling company in accordance with their respective shareholding. So here we are bumping up the base cost. The next one is that this one is the new proposal, which came as a result of the discussions we held last year. The second proposal is that changes be made to ensure that this measure whereby the limitation of expenditure in respect of shares held in an unbundling transaction applies to shares that are acquired by way of an unbundling transaction and not to those shares that are acquired through other subscription or acquisition for a full consideration. I wish to bring to the members' attention that these rules are meant to assist taxpayers moving forward. They are meant to assist taxpayers in the future disposals. So I think these rules will be welcomed because they take away a lot of the comments that were raised last year. Next slide. The last one on the business tax is the clarifying rehypothecation of collateral within collateral arrangement provisions. In 2015, changes were made in the Act to allow for an outright transfer of listed shares or local and foreign bonds in a collateral lending arrangement. As a result, if a listed share of foreign government bond or local government bond is transferred as a collateral for an amount owned by the transferor to the transferee, there are no income tax implications and securities tax implication, provided that the identical shares are returned to the transferor by the transferee within a limited period of 24 months from the date of the transfer of the collateral. So this rule was aimed at assisting taxpayers on the transfer of the outright collateral. So at issue is the rehypothecation of collateral where the bank, broker, dealer, or collateral taker intends to use collateral received through a tax-neutral collateral arrangement for trading or as security for its own borrowing. So the use of collateral for purposes other than the subsequent collateral arrangement is against the policy rationale for these rules. Remember, these rules were meant to assist taxpayers. So it is important that the collateral arrangement must be used for the intended policy rationale, not for other purposes. Next slide. In order to stop this, it is proposed that changes be made to the legislation to clarify the policy intention that the shares or bonds transferred as collateral in terms of a collateral arrangement may subsequently only be used for collateral and not for trading or other financial transaction. As a consequential amendment, it is proposed that clarification be extended for SARS to identify and sanction the improper use of the collateral received by the transferee during the 24-month time frame of collateral arrangements. In view of the fact that we are capping abuse, this also is the third proposal whereby the effective date is retrospective, that is on the date of the publication of the draft TLAB for public comments, that is 28 July 2021. I wish to bring to the members' attention that we have already received strong comments from the taxpayers regarding the retrospective effective date on this. So next week, when they come for public hearings in Parliament, I'm sure they will be dealing with these issues extensively because the effective date is retrospective. Next slide. Next slide. Oh, this one is taxation of financial institutions, that is insurance, businesses, and banks. The proposal is clarifying the transfer of liabilities in respect of insurance businesses between short-term insurers. Currently, Section 28 of the Act deals with taxation of short-term insurers. On the other hand, Section 29 Cap A of the Act deals with taxation of long-term insurers. However, the Section 28, which deals with taxation of short-term insurers, does not specifically address all the tax consequences that arise from the sale of or part of insurance business. As a general matter, the sale of an insurance business requires the buyer to assume all outstanding liabilities with the obligation to settle any future claims as recorded in the seller's accounting records at the date of the transfer, and have no right to all future premiums receivable under the insurance contract. So in order to address these concerns, it is proposed that changes be made in the Act to clarify the tax treatment applicable to both the seller and the buyer of transfer of liabilities as part of the transfer of short-term insurance businesses. Next slide. This one is the clarification issue of taxation of long-term insurers in Section 29 Cap A. In 2012, changes were made in the Act by revising the deduction formula for selling, administration, and indirect expenses for long-term insurers. In general, this formula is based on taxable income divided by net economic income. At issue is that unrealized gains are to be accounted for in the denominator does not specifically refer to any level of aggregation. So this is more of a technical issue whereby we have to take into account the unrealized gains. In order to address this anomaly, it is proposed that changes be made in the deduction formula so that unrealized gains and losses should also be aggregated for all assets allocated to the relevant policyholder fund. This is assisting taxpayers, so there is no controversy. Chris?
Sure, that was a marathon, Yanga.
Okay, there are a few more. The first is just on incentives. So we've got an urban development zone incentive where we try to encourage property investments in CBDs to address dereliction and dilapidation, to promote investment. It's been in place since 2003. There have been a few sunset dates which have been extended after some reviews. In the budget this year, the minister announced that it would be extended for another 2 years. So at the moment, the sunset date is the 31st of March. We'd like to extend it to 31st of March 2023 so that we can do another further review on this incentive. Similarly, for the Learnership Tax Incentive, this was also introduced in 2001. It encourages skills development and job creation. It also had a sunset date a few years ago in 2016. We did quite a lengthy review where we tried to look at this and made a few recommendations at the time to try and improve the targeting. We've got some more information so that this new form is filled out so that the next time we do a review, we've got more to work with. The incentive was set to finish in March 2022, but we'd like to extend this for another 2 years to the 31st of March 2024 so that we can look at that new data and provide a more sufficient review on it. There's also, we've made some changes to the Industrial Policy Projects Incentive, IPP. It's in 12I of the Income Tax Act. This was introduced in 2009 to support manufacturing assets and improve productivity. It had an adjudication committee which would assess projects for approval using a point system. And there are all these criteria that need to be met in terms of these projects for the incentives to apply. The sunset date did come around for the Section 12I incentive on the 31st of March 2020. At the time last year, it wasn't renewed. However, projects can are still applicable and can be still use this incentive as long as they were applied before that date. The problem with COVID was that a lot of the criteria in order to continue qualifying for this incentive going forward for the life of the manufacturing asset, a lot of those criteria couldn't be met. For example, there needed to be a particular level of training that needed to be done in person, which couldn't be done during COVID. Assets needed to come into place and into use at a particular point in time. There was a time frame in which they could come in, and that also wasn't able to be completed through COVID. So these changes that we are proposing in the TLAB are to allow further time for those projects that have been approved in order to comply with the criteria that are set out for this incentive. So there are a few extensions there on the compliance period, and they can still recommend to the Minister of the DTIC the provisions that they need to comply with. Thanks.
Next slide. Clarifying the controlled foreign company anti-divisional rules. So we are coming to propose amendments to international tax. Currently, South Africa has got controlled foreign company rules. These are anti-avoidance rules that are aimed at taxing South African residents on the net income of a controlled foreign company. A company is regarded as a controlled foreign company if that foreign company is more than 50% owned by South African residents. So let's say if you've got a foreign company in Botswana or UK, and more than 51% of that foreign company is owned by South African residents, the income of that company will be included in the South African tax net as it arises and be subject to tax in South Africa. Yes, in order to alleviate double taxation, the South African Revenue Service will have to give credits in respect of foreign taxes paid. So when we introduced these rules, there was a plea that we have to strike a balance between protecting the South African tax base by introducing these controlled foreign company rules and the need for South African multinationals to be competitive internationally. Because if you keep on taxing the South African foreign-owned companies internationally, meaning that they may not be competitive. So in order to strike a balance between anti-avoidance and the need for competitiveness, we introduce exemptions within these rules. So the exemption that we can focus on here is the foreign business establishment exemption. The foreign business establishment exemption is more like a greenfields exemption, whereby you can see that the company has got a factory, there are people working in the factory, the company is not incorporated or formed in a foreign jurisdiction only to avoid tax. That company has got workers and is producing. This exemption makes provision for CFC income to be exempt if that income is attributable to a foreign business establishment as defined in the Act. That if it's attributable to that greenfields investment. So in order to limit the tax avoidance, the foreign business establishment exemption has got further limitation, which are anti-divisional rules. So even though there is foreign business establishment exemption, but if we see that the income is diversionary, that the income is more of a transfer pricing, then the foreign business establishment exemption will not apply. So these rules were introduced as early as 2001. However, in 2011, the anti-divisional rules in respect of the CFC outbound sale of goods were abolished. And the rationale for the removal of these rules was that the transfer pricing is enough to counter the avoidance. However, in 2016, we reinstated the anti-divisional rules due to their effectiveness in preventing base erosion and profit shifting BEPS. Because in 2011, we removed these rules, but due to the OECD BEPS measures that are taken into account. So we deem it fit in 2016 to reinstate these rules. Therefore, but however, in 2016, when we reinstated these rules, we omitted the rule that the goods should be physically delivered in that country of residence of the CFC. Because we omitted the small issue of physical delivery, taxpayers are using that omission so as to avoid tax. For example, let's say you've got a foreign company in Botswana, and that foreign company in Botswana buys the goods maybe from South Africa, but we found that the goods are never physically delivered in Botswana. So the purpose of this proposal is to bring back the word physical delivery, so as to ensure that there is no avoidance of tax, so that if that CFC in Botswana has bought goods from South Africa, those goods should be physically delivered in the country of residence of that CFC in this scenario, Botswana. So this is one of the anti-avoidance measures. Next slide. Clarifying the interaction. The previous one. Clarifying the interaction between provisions dealing with a foreign company ceasing to be a CFC and the participation exemption. Last year, we made changes in the Act because there was the whole review of the exchange control system. As a result, changes were made in the Act due to the fact that of the withdrawal of the approval by SAP for loop structures. One of the amendments made was in relation to the participation exemption for gains on the disposal of shares in the non-resident company to a non-resident. This amendment was made so that the participation exemption does not apply to the disposal of shares in a CFC to the extent the value of the assets of the CFC are derived from South African assets. At issue is that the amendment mentioned above creates uncertainty in the application of the rules, where a foreign company ceases to be a CFC as a direct or indirect result of the disposal of equity shares in that CFC. So in order to address this, it is proposed that changes be made in the Act so that when a portion of the resulting gain or loss resulting from a CFC ceases to be a CFC is not regarded in terms of paragraph 64B, the application of section 9H is not precluded. So this rule is also assisting taxpayers. Next slide. This is also assisting taxpayers. Currently, we've got withholding tax provisions on royalties, interest, and dividends. With regard to withholding tax on royalties, the withholding tax applies to royalties from a source within South Africa, paid by a person, whether that person is a resident or not, to a foreign person. However, this withholding tax on royalties can be reduced by application of tax treaties. This is the case also in interest and dividends. However, with regard to interest, the income tax makes provision that a person must not withhold at the prescribed rate if the foreign person receiving interest has submitted a declaration that the amount is exempt from withholding tax on interest as a result of an application of double tax treaty. So the interest has got a rule to say that the minute the foreign person makes a declaration, so the onus is on that foreign person. If that person makes a declaration to say, there is a tax treaty between South Africa and that country that reduces the withholding to 0 or to 5%, then there should not be a withholding, or the withholding should be at the lesser rate. However, with regard to royalties and dividends, there is no rule that makes provision for such a declaration. So in order to address this anomaly, it is proposed that changes be made on the withholding rules with regard to royalties and dividends so as to make provision for that declaration. So this is ease of tax administration for both taxpayers and SARS. Next slide, the VAT one. The first one is zero rating of superfine maize meal. In South Africa, the grading of maize products is regulated by Department of Agriculture in terms of the Agricultural Products Standards Act. Before 2016, this act allowed for 18 grades of maize products, including the below mentioned to be sold in South Africa. In 2016, another grade of maize product, namely superfine maize meal, was added to the list regulated by the Agricultural Products Standards Act. So meaning that before 2016, there were 18, now after 2016, there were 19 graded maize products. at issue is that when the Department of Agriculture made changes in their act, we did not update our VAT Act to make changes to the VAT Act to allow for the zero rating of superfine maize meal. So this proposal is to align the VAT Act with the Agricultural Product Standard Act, so that the VAT Act currently has 18, so we're gonna have 19 graded maize products that are subject to zero rating, so as to align our act with the Department of Agriculture's Agricultural Product Standard Act. So this is just an alignment. Next slide. VAT treatment of temporary letting of residential immovable property. The VAT Act makes provision for the supply of residential fixed property by a VAT vendor to be subject to VAT at the standard rate of 15%. That is on the sale of residential fixed property. However, the leasing of residential fixed property is exempt supply, which will generally result in the VAT incurred being denied. So developers will develop the property. However, before they are able to sell, you'll find that they are renting the property so as to generate profits, because it takes time to sell. So now there's an issue, because if you sell the property, there's VAT, but if you rent, then that is regarded as an exempt supply. So there's an anomaly on the VAT treatment by the developer of the same property, based on the fact that when you sell it, it's VATable, but when you rent it out, it's exempt supply. So in 2010, there was an announcement that was made in Chapter 4 of the 2010 budget review, so that we can make changes to the Act so as to close this anomaly. Next slide. The changes were made in the Act, but those changes were temporary. That is, were inserted from 2012 to 2018 that were applicable for 4 years. So now in 2019, because those changes were temporary, the property developers came to us to say, maybe we need a permanent solution rather than a temporary solution. So the proposed amendment to the VAT Act are meant to address these concerns, that we insert a new section, which is similar to the section 18B that was inserted from 2012 to 2018, but maybe on a permanent basis. Next slide. Reviewing the section 72 decision with regard to the VAT treatment of telecommunication services. In 2019, changes were made to the VAT Act to remove the section 72 discretion by the commissioner. These changes had an impact on the decision made in terms of the VAT Act before 21 July 2019. In the 2020 budget review, we undertook to address this concern by reviewing the impact and the role of this arrangement and decision to ascertain whether which decision should be discontinued, which decision should be extended, and the changes that required to be made in the law. And one of the decisions that were impacted was VAT treatment of telecommunication services. Next slide. With regard to the VAT treatment of telecommunication services, South Africa is bound because of the international agreement that South Africa entered into. The first one was the Melbourne International Agreement. The second one was the Dubai International Agreement. In terms of these international agreements, the South African VAT vendors may only levy VAT on the charges if the customer has a South African billing address. South African vendors supply roaming and other services to non-resident telecommunication suppliers are thus obliged, in terms of this Dubai ITR, to zero rate these charges levied to their non-resident counterparts. So in 2020, we made changes in the Act to introduce a new zero rating provision in order to ensure that the provisions of the Dubai International Agreement are upheld. However, in the response document, we noted that any further proposed amendments regarding the implementation of the Dubai International Agreement could be considered in the 2021 legislative cycle. Based on the above, it is proposed that further amendments be made in the provisions dealing with telecommunication services in order to align these provisions with the Dubai International Agreement, but subject to certain limitations. So here, we are making changes in the VAT Act so that we align the VAT Act provisions with the Dubai International Agreement, because the 2020 provisions were not too much aligned. Next slide. Chris, carbon tax.
Thanks. There are a couple of carbon tax amendments as well. The first one is the Renewable Energy Premium. So in the Carbon Tax Act, if there is an electricity generator and they were using renewable energy through the REI PPPP program, Renewable Energy Independent Power Producers Procurement Program, there was an additional tariff in the first few rounds, which was quite high. And the original Carbon Tax Act then allowed for a value to be taken off the carbon tax amount, in effect to cater for that additional tariff in the renewable energy contract. So there was some confusion about who this would apply to. And some in industry thought this would apply for anybody who then used renewable energy. We needed to clarify this. So we're going to clarify that this is just for purchasing additional primary renewable energy directly through those REI PPPP programs, or private independent power producers where there is a purchasing power agreement or contract. So we're going to clarify that and show that that's the amount, and those are the taxpayers that can then use those renewable energy amounts to reduce their carbon tax liability. The renewable energy, how much you can reduce in terms of using renewable energy, is published by the Minister in the Gazette, which we published quite recently to show the exact values that they can use for their filing. The next one is on carbon sequestration, which is how much carbon you take out of the atmosphere through some of your activities. It's usually used for in forestry, in plants, and others where, for example, actual forests take carbon dioxide out of the atmosphere. So there is a guideline document that's been published by the Department of Forestry, Fisheries and Environment to show, and it's in line with the IPCC, it's quite an established methodology of how much carbon can actually be sequestered directly through these activities. We have included it for forestry and paper and pulp, but there is harvested wood products that also would like to apply for this. So harvested wood products, actually taking that wood and putting it into something, creating something. But now, the sequestration available to that is quite difficult to check. So although it's there with the IPCC, if you have a harvested wood product, but then it leaves and it goes somewhere else, if it's burnt again, then the carbon goes back into the atmosphere. The other concern we have with it is that there's no reporting other than immediately at the mill gate. So you don't know what happens to it after it's left. So we are only going to limit this to particular forest plantations rather than to all harvested wood products. The next one is on using the carbon sequestration against fuel combustion emissions. So in the Carbon Tax Act, you can then reduce the amount of your carbon tax liability through how much is actually sequestered. So in effect, you take a net amount. So you say, this is how much carbon I've emitted, but this is how much I've sequestered, and you take a net amount to see how much should then be reported. But there is a potential for double counting here, because in another portion of the Act, it says, well, you can actually then also deduct those same sequestered emissions as well. So we need to just make sure that we don't have that double counting occurring in practice. So to do that, we're going to say that sequestration for forestry plantations are deductible only for fuel combustion emissions, because you could also have process or emissions. And the deduction for sequestration geological reservoirs is limited to emissions in that particular section of the Act. So that should hopefully cater for that double counting. We also wanted to clarify the carbon budget allowance. So there's a 5% carbon budget allowance. If a company voluntarily submits and uses the carbon budget system that is put forward by DFFE, they will then get a 5% carbon budget allowance, which can reduce their carbon tax. Now, there were questions about how can this be applied in terms of, there was a timing issue. At the moment, that voluntary carbon budget system has just actually been extended to end on 31 December 2022. So the carbon budget allowance will then also be extended to that period. But companies are worried that if the reporting is only in July 2023, that they can't use the actual 5% in the current wording of the legislation. So we're just making sure that even though there's this mismatch between the timing of when filing is made to SARS, which is 6 months later, and the time of which the actual carbon budget offset allowance is used, they can still use it. It'll be applicable for that previous year. So we try to adjust that. The last one is on the Schedule 2 emissions. So there's a Schedule 2 that's published with the Carbon Tax Act, which shows which industries are applicable for the Carbon Tax Act and the thresholds in terms of production or outputs at which they are applicable. Now, that is based off the Department of Forestry, Fisheries and Environment, because they publish national greenhouse gas emission reporting regulations. So our Carbon Tax Act is linked to that. So when they make adjustments, we also then need to make adjustments to amend for which sectors should be included, so that when they report to the DFFE, they also then are included in the carbon tax net, and for the thresholds, because when they make adjustments to those thresholds, it will also have an impact on who then reports to SARS and the Carbon Tax Act. So we're just aligning those two. That's all on my side. Thank you.
France or colleagues from SARS?
Thank you. I'm just battling a little with the unmute and switching the video on. Hopefully I'm now done. Hello.
Go ahead, Franz. I can hear you.
All right, good. Thanks. As I say, just having a little battle there. Okay, so I'll try and be brief because I can see the clock is against us. The question here is on the Income Tax Act and an amendment around the receipts that are issued for Section 18A deductible donations. SARS has fairly wide powers to require third parties to provide information. And as you'll see here, at the moment, we're not using that with respect to the PBOs or public benefit organizations that are issuing receipts. So that's something we want to get to in the future. But equally, we'd like to make sure that the information that in the receipts, that is in the receipts, matches the kind of information we're going to be requesting from the PBOs. So we're proposing an extension of the information by way of a notice issued by the Commissioner, much in the same way as the reporting requirements are established by notice by the Commissioner. Moving on to the next slide. At the moment, if taxpayers are required to give us monthly returns for employees' tax or pay-as-you-earn, and they give us a reconciliation return every 6 months. Now, if you don't give us the reconciliation return every 6 months, we can impose a penalty. But the problem comes in is if people have not been giving us monthly returns, or not all of them. And so at that point, we have no idea as to how the penalty should be imposed because the information is not available. And so we can only impose the penalty once we've got the return, which limits its deterrent effect. So the proposal here is to permit SARS to raise an estimate of what the employee's tax should be based on the information we do have available. And then once the return is in, we can adjust the penalty based on what the actual figures are. But this hopefully will get the employer's attention a little bit more quickly. And moving on to the next slide. Now going the other way, now assisting the employers, we've got a situation where an employer can be double penalized for miscalculating or under-declaring the value of a fringe benefit. And so the proposal here is to remove the potential for a double penalty. Moving on to the next slide. Okay, now at the moment, we have things called degrouping depots, and the immediate question may be, well, what's a degrouping depot? So if you think about it, some importers will import goods in too small a scale to take up, say, a full container. So what you may then have is a clearing agent or a transporter that will consolidate multiple loads into the container, and then they will arrive in South Africa. And then you've got to so the loads were grouped, and then when they arrive in South Africa, they've got to be degrouped so they can be sent off to the various importers. Now, as I've explained it, that the current focus is then on imports, but it may well be that some of these goods now need to be re-exported. So of the 7 items that were in the 7 groups that were in items that were grouped into the container, 3 of them are for local and 4 are going to be exported onwards. So that is unnecessarily limiting. So the idea here is to open up the potential now for the degrouping, not only to come in from a transit shed, but also to go into a transit shed so that it can go both ways. So extending to assist trade here. And then we have the SAFE framework, which is a standard set by the World Customs Organization. We've been tweaking the rules in order to make our accreditation system more closely adhere to the SAFE framework. And so there are some consequential amendments into the primary legislation that we are proposing here to assist in that regard. On to the next slide. And then here we have a set of figures in the Customs and Excise Act that were last updated in the 1980s. Essentially what this is all about is there are margins of error that the Commissioner can accept when people calculate the customs duty or the excise duty on import, or more generally. And so if there is an error, which either goes against the Commissioner or in the Commissioner's favor, we can accept that error so that we're not chasing after small amounts. Currently, the amounts range between 50 cents and 5 Rand, if I remember correctly. There's a 50 cents, there's a 1 Rand, there's a 2 Rand, and I think there's a 5 Rand there. And those were last set in the 1980s. So the suggestion and the proposal here is to increase those tolerances for error to up to 100 Rand to assist in streamlining administration and compliance costs. And that's it from my side. Thank you.
Okay, Chair. No, Chair, thank you. I think we finally finished. Thank you to members for being patient with us. You can see this is an annual ritual and what one former minister used to describe as death by PowerPoint. However, I think the death actually reading through the actual legislation is far worse. So I think we're trying to just present this in a simpler way, bring your attention to what we consider the key issues. And I think for the tax process, as you know, it's only, given that we don't consult people before we make tax announcements because they're market sensitive, we have one round of quick consultations with affected parties, mainly sometimes after the announcement, just so that we get the law right. And once we publish these draft laws in July, that's really the first time that the legal people can come and comment and see how the announcements that were made in February are given effect. And we too, I think, always are keen to hear the inputs that come. And as you know, we're quite open then to responding and making changes where we think valid points have been raised. So Chair will stop there, and we look forward to the to questions now, and obviously to the hearings process once comments are submitted. Thank you, Chair. Chair, I should say that I know the minister popped in, but I see he left then at some point. So just wanted to bring that to your attention. Thanks.
Okay, thanks. Thanks, Momo, Yanga, Chris, and the entire team for their presentation. Let's now move to item 3, discussions. Honorable members, there's the platform. You can raise your hand if you want to make a comment or raise a ask a clarity seeking question. Over to you, members. Noxie, there you are.
Okay, Chair. Thank you so much. It is indeed a marathon, Chair.
Sure,
It's a
sure.
marathon. Can you hear me, Chair?
Yeah, can hear you loudly. You're loud.
Okay. Oh, okay. I was just saying it is indeed a marathon, and I think at some point, Chair, when we have all vaccinated and can really abide by the COVID regulations, we have to sit down with Yanga and the team, Chris and all the other members of the team, so that they can really walk us through the changes. I understand there has been these marathons now for years, but I thought this year it has really been quite a marathon. Many changes that have been made, and so my first take really is to just find out, because at some point we are going to have to listen to the stakeholders, sorry, as they interact with the TLAB and TALAB tax laws. So if Yara could just give us an indication as to the strong comments that have come out from the stakeholders regarding the retrospective, and what the responses are to those strong comments. Maybe first what they are and what the strong, responses are, because I think the responses have to be equally strong for the people to be able to really understand what what is inputted upon them. The second thing I wanted to just find out from from Yanga and is the issue of, as raised, L&D, and that account being final, then decisions can be made. I didn't quite get that, and would really love to